Yeah, well, Roee, as you saw and you heard Mr. Terrett, they missed both on the top line and on the bottom line. The stock was actually down 11% after hours, down to $156 per share. And what we could see after hours is, to your point, Roee, that the market did not like the fact that they wanted to sell additional shares to fund their future transformation. So it could be potentially highly dilutive if they follow through on that. What we saw in the earnings was that the transformation, though, is showing signs of light at the end of the tunnel. The e-commerce sales were up 175%, which is now 34% of total sales versus 12% the same time last year. They shut down another 693 stores last year, so they are moving aggressively in that direction. They built up some cash. They paid down $57 million of debt. They sold the private jet. What else could you ask for? But I have to say, no questions from analysts, and they suspended all guidance. When you see a change of CFOs and you see a change at the top so materially, and they don't take questions and they don't give guidance, ordinarily that's not a good sign. We'll see what's the case moving forward.
Has the Wall Street bets phenomenon been good ultimately for GameStop? I mean, its stock is worth more, but is the company actually more valuable?
Yeah, it's hard to say. What the market has really been looking for is a clear plan from Ryan Cohen, the founder of Chewy. He's put himself on the board as well as two other people. They now have a new COO that's come over. She ran distribution at Amazon. They have a CTO who was part of AWS at Amazon. So he is attracting quite a few people that are consistent with the vision to become an e-commerce company. But the vision is one thing. They haven't really laid out the plan. The consensus price target on Wall Street among analysts is $14.65. The most optimistic people are, $30 to $35 plus. To get to even 156, never mind 380 or 480, where it's traded up in recent months, is a very, very tall order, and it's really pricing a lot of things going right that may or may not be the case. And I think the company recognizes that, and they're now discussing, should we just sell stock at these elevated valuations so that we could raise capital to eventually move ahead with this plan of digital transformation. But it's really a long haul. It's been compared in the past to Radio Shack, shutting down stores to go online. I think this has a better shot, but it also has a tremendous amount of competition, Roee. You've got Apple has their own services online called Arcade. They charge $5 per month. You can play 100 games. Google has Stadia, which is $10 per month. And then many others have their own Xbox Live, Switch Live. Sony has their own. And then you have free games like Fortnite and different programs, Apex Legends, that are going to directly compete. So not only do they have to move dramatically in a new direction, they have to do it extremely quickly, and that's going to cost a lot of money. So the jury's still out, but I think at $156, that's assuming quite a lot goes right, and many of the fundamental analysts on the street don't see anything like that in the near future.
And the company could have the grandest plans for all of this transitioning, but can it survive if it continues to miss expectations?
Yeah, well, they did build $635 million of cash, so they do have some cash to get them through, but shutting down the stores is going to cost money, and it's really a bet on the jockey. With Ryan Cohen's success with Chewy, people are hoping that he can cause that type of digital transformation, but it's really a big bet, and there are also structural factors at play that have enabled the stock to levitate at these levels. One is the short interest is still around 41%. So anytime a headline or any type of good news comes out, there are still enough shorts in the stock that if the price gets bid up, if you see a tremendous amount of retail option buying, that forces the dealers or the seller of those options to hedge that option position, that short option position, by buying stock in the market, which encourages the retail people to buy more call options, which requires more hedging. And as they buy stock to hedge out their position, it squeezes the short sellers, who then have to buy stock to cover their positions. and avoid margin calls. So it's a similar situation to what you saw in January. It's less pronounced in that in January you had 140% short interest. Now you only have about 40% short interest, but you're going to see this kind of volatility until it comes to some level of real valuation. On the actual value, $12 billion market cap, 14 billion enterprise value makes no sense. It's probably overvalued here for sure. If Ryan Cohen can fulfill 50% of what people are expecting from him, maybe you could see 40 or 50 or $60 many years out as it settles out into a real valuation. But for now, it seems like a lot of speculation and a lot of risk moving forward.
I can't tell you this, it's been fascinating to watch. Thomas Hayes, Great Hill Capital, thank you for joining us.